G'day folks, it's Jim here. It is Saturday the 28th of August and the Jackson Hole Symposium has now come and gone, allowing traders to breathe a little more easily perhaps as Fed Chair Jerome Powell wound back a little bit on the prospect of an immediate reduction in the tapering bond buying program, and this despite some hawkish comments leading up to the symposium itself from various members of the Fed board. While Powell reaffirmed that the Fed would begin tapering bond purchases later this year, he didn't say exactly when that process would begin, and reiterated his previous comments that he was still fairly confident, or is still fairly confident, that the recent spike in inflation is temporary, and that's why the Fed shouldn't rush into any immediate program to tighten monetary policy. Looking ahead, we've now got the next major event. We seem to be trading from one event to the other at the moment, but the next one coming up will be the US employment numbers and the non-farm payrolls. They're going to be due on Friday, and they may give us a clearer picture of when we might be expecting tapering to begin. Obviously, the stronger the numbers that come out of the non-farm payrolls, I think we're expecting 670,000 or something like that at this point in time. A good number will see prospects of immediate tapering grow, while obviously a poor number will see tapering possibly be delayed till the other side of the new year. But that is not the way it looks at the moment. The other major caveat, of course, in all this is COVID and the Delta variant, the rapid spread of that. And also, we need to be keeping an eye on supply channels. The shipping channels they seem to be more or less broken at the moment. So they could have a major effect on the way things move looking down the track. In the meantime, as far as the market's concerned, the S&P and the NzdUsd both closed at all-time highs. The S&P actually made it to 4,500, closed above 4,500 for the first time ever. The US dollar, that saw some spiky action around Jerome Powell's speech, but in the end it didn't really do an awful lot. The dollar did end weaker, down about or 1/3% on the dollar index, but at the same time it really stayed within previous ranges. The commodity currencies had a good session. They liked the positive risk tone coming out of the fact that we're not going to see an immediate move into tapering. So that helped the Aussie and the Kiwi in particular. In the commodities, gold, oil had a good week. That closed up 10% over the course of the week. Gold and silver, the metals, they've been choppy all week, but they closed near their highs on Friday, and probably look good for further gains in the coming week. They were generally helped by a softer dollar, and their next direction will probably be largely dependent on where the dollar does head. Iron ore continues to improve as well. It closed up about 5% to 6%, I think, over the course of the week, and that helped the Aussie out moving into the weekend. So with all that, we'll go and have a look at the charts and see what they've got to tell us.
Okay folks, we'll start off with a weekly chart of the dollar index, and as you can see, the last week really it gave back the gains that it made the week before. If this is a reverse head and shoulders, and I'm beginning to wonder if it is or not, but if it is, the encouraging sign is that it did close above the neckline still, so it kind of remains valid as a proposition. But it is taking its time about it, and I'm beginning to lose a bit of enthusiasm. But having said that, the weekly charts do point towards a higher dollar still, maybe running out of steam a little bit, but they do look mildly positive. If we come back towards the dailies, we can see that we did have a negative session on Friday following the Jackson Hole comments. But as I say, we're above the neckline. The dailies, though, the momentum indicators, which had been looking higher this time last week, have now turned around and appear to be losing steam. The dollar really hasn't got on with it, which he should have done if we were going to really see further gains. So I'm at this point becoming fairly neutral in my outlook on the dollar. I think come early next week, we might see further dollar selling, if anything. Which might push us back down to the neckline, which currently sits around 92.50. That's not so far away from where we are now. It probably takes us on to 118.40 or change in the euro. And if we break through this and we continue lower, then we're likely to come into support down around these lows here, sort of 90 or 92.5, which is where we bottomed out previously, and a break below there would take us down into this area here around 92. As I say, I'm pretty neutral at the moment. I don't really have much of an axe to grind either way. Let's go and have a look at the euro and see what that looks like. Okay, so we start off with an hourly chart of the euro, and you can see we had an initial spike lower, and that quickly got reversed, and the euro finished on its close to its highs of the day. And we might even have a little bit of a bullish flag here, which I guess potentially 1730 to 118, so that's 70 points, could take us up to 118.70 or so if that turned out to be the case. Not sure that it will. The hourlies, they do look positive, and it wouldn't surprise me actually to see some further dollar selling early on Monday as follow through from that move on Friday. So I guess resistance comes in at around Friday's highs, just above 118.03. If we go out to the further out charts, we'll go and have a look and see where next resistance will be. And we've kind of broken this trend line, and the next FIBO level, that's not till 118.90. If we go and have a look at the Ichimoku chart, so let me just go to those, and here we are with a daily Ichimoku chart. So, and the base of the cloud here on Monday is going to come in around this sort of 118.40-35 level. So that's going to act as some kind of resistance if we see it, I think, which kind of ties in with this high back here. So look out for that. I think we might well see a move towards 118.35. If we go beyond there, then that flag formation on the hourly charts to 118.70 might come into play. On the downside though, Friday's lows at 117.30 will come into play, and that ties in with the daily's Tenkan down here. The Tenkan's 117.32, so that would be support if and when we saw it. And probably a buy there on the day. I don't think it's going to get there. Looking further out though, the daily charts, they look slightly positive. We've got some minor bullish divergence. So in line with the daily charts on the dollar index, which appeared to be showing the US dollar turning slightly lower, we're right up against the neckline of this head and shoulders, and we probably need to break that at sort of 118, right where we are at the moment. And if we go through there, then the 55-day moving average, that comes in at 118.38 level, and beyond there, the next FIBO coming back here, as I said, was at 118.95. So those are points to look out for: 118.40, 118.70, 118.95, 119, the figure which that was the high of a few weeks ago. Looking at the weeklies, now they do still look slightly negative as per the dollar index charts, which has suggested bullish dollar outlook. On the downside, let me blow this up a bit. We've got that 117.30 level that I spoke about. Below there, the weekly low was at 116.87, and below that 116.5, and I don't think we're going anywhere close at the moment. The only thing that might change that is if we got a stellar non-farm payrolls on Friday, which could alter the tapering view once again and preempt a stronger dollar. But until then, it does look to me as though you probably need to be buying dips down to sort of 117.30, 117.50, looking for a move early in the week to 118.5-ish, maybe even possibly eventually to 119, but I don't think that's going to happen yet. Moving forward to dollar yen, and covering this very quickly, dollar yen is choppy, horrible trading conditions. I don't think I'd be involved. The 4-hour charts point a little bit lower, so I wouldn't be surprised to see some dollar selling on Monday. But really, if we get down to the low 109, so 109, 109.20, I'd probably be looking to buy it. Really, anything above so this 110.25, be looking to sell it, I think, early in the week. I don't really expect to see an awful lot at all. And more choppy trade, a la what we've been going through, seems to be the way of it. Moving quickly along to sterling, and here we have a 4-hour sterling chart, and as you can see, we saw this spike higher after Powell's speech on Friday. The indicators are pretty flat, so I'm not really enthused about sterling, but I do think we could see further strength in cable early in the week, but I don't think it's really going too far. This kind of 138.5, 139 area, I think is probably pretty good resistance for it if we get there. We're sitting at what 137.5 at the moment. We need really to take out this high and this trend line, and that could propel some new buyers. But really, I'm not really looking at sterling too much. As I say, the indicators aren't showing as much, and the same applies to the dailies. They're pretty flat. If we blow this up, we've got the 200-day moving average, the pink line, sitting here at 138 basically. The 100-day moving average just above 139. So I don't think we're really, I don't think we're going to go and test that. On the downside, on the 4-hour charts, we come back here. The lows down here, 136.80. I think if you see it back down there, you probably look to be buying it, but with a tight stop loss further down. It's below 136.25, I suppose. If we go below this 136, and maybe that's where you put your stop loss, but then I think we can possibly go back to these lows. But I certainly don't think we're seeing that early in the week, and it's just going to be a messy, choppy sideways kind of play. The Aussie had a pretty good week, really. Helped in part, I guess, by the recovery in the iron ore price. Certainly the COVID situation is doing no favours to any of us. But this time last week, when we did a video, the Aussie was down here around this sort of 71, it was down around 71.30, I think it was. And here we are at 73.15, and looking like we've got an hourly bull flag here. If that were to be the case, a measured target would be somewhere up here around sort of 73.90, I guess, in line with these highs here. I'd rather be long than short, although the hourlies are a little bit overbought at the moment. But the 4-hour charts do seem to point higher. So if anything, I'd be looking to buy any dips that may come about because of the overbought situation in the hourly charts. Look to buy dips maybe but just below 73, maybe 72.85, 72.90. But I think we're probably going for a retest of this level here around 74, 73.90, 74. And if we were to break that and this high here, it's sort of 74.28, then 75 comes back into play. I think that's some way off at this point in time. We need to keep an eye on COVID. We need to keep an eye on the iron ore price. But right now, while risk remains positive, all signs look to be headed towards trying to be long of the Aussie. And the same applies to the Kiwi. Here we have a 1-hour Kiwi chart, closed on its highs, slightly overbought perhaps on the hourlies, but the 4-hour charts are telling us that the Kiwi's in recovery mode. The dailies, likewise, they seem to be pointing a little bit higher. So really, I wonder if this might be a bull flag. And really, if it was, the 69.30 to 70 points, so that could take us up to sort of 70.90, 71 cents, something like that, in line with these highs here. That would be my play for early in the week, I think. But stop loss probably below this high here. Where's that? 69.80. I'd probably give it a few points. Maybe down here around sort of 69.5, or even at 69.30 if you can afford it. But I think buying dips now below 70 cents, looking for 70.90. That's really the plan of the day, I think. Moving along to the stock markets, and here we have the S&P 500. And once again, as you can see, it closed at all-time highs, above 4,500 for the first time. The 4-hour charts, which had spent a little bit of time consolidating, turned a little bit lower, but they now look as though they're trying to move higher again. The dailies, not really telling us a great deal at this point in time. They're probably pointing higher, if anything. I don't have any change in my long-term view. I think we're going to continue to see a very slow grind higher. I thought 4,500 might be the end of the year target. Probably have to push that up to 46, 46.5 now. On the downside, looking at an hourly chart here, the first minor support comes in at this sort of 44.80 level, 44.85, and I guess that's where you should be looking to buy it on Monday, probably with a stop loss under the 200-hour moving average, 44.5. But further out, if we go to the 4-hour charts, a break of that support line brings us back down to the FIBO level. That also is around 44.5 to 23.6% level. And then we've got these two rising trend lines. They're down right here around just 4,400. So from where we are at the moment, that's what a 2.25% fall, which in the bigger picture really is absolutely nothing. We could see that any day of the week. But once again, if we did sit down around here, I think I'd be looking to buy it for the time being, because I can't really see anything at this point in time that's going to cause a major turnaround in the markets. Going forward to the dailies, and here we can see a clearer picture of that rising trend support coming up from the March low of 2020. The 200-day moving average ties in there. Below there, the 100-day moving average comes in at sort of 42.70 or so. As a word of caution, as usual though, the weeklies, let me blow that up a bit. We've got this. We haven't had much of a setback at all. But the weekly charts do remain in overbought territory. So don't be surprised if we do see a swift downturn. And as I say, 2.25% in the bigger picture is nothing. We need something fairly significant, I think, to get us heading further south than that at the moment. So overall plan, really buy dips, with Monday looking at sort of 44.80, and then further out maybe at 44.5. And down here, the major level, 4,400, the rising trend support. I'd definitely keep a stop. This low here, if we were ever to go below this, 43.5, I'd be out of all long positions for the time being, because then I think we could probably go back and visit these levels down here. So just something to keep an eye on, but at the moment, buy dips. And now moving forward to the Aussie market. And here we have a 4-hour chart of the ASX 200. Now that's struggling below the all-time highs set back the early part of August, but we've had some pretty poor COVID news coming out. We've got another 1,000 new cases today, 1,000 plus. The iron ore price it's recovered this week, but China still seems intent on pushing it lower. So for the time being, I think as long as the US markets stay constructive, I think the Aussie market will follow suit to a certain extent, although I don't think we're going to be taking out this level at any time soon. So we need to really hold this level support, this being at 74.70, and I think we'd probably like to do that on Monday. If we can take out 75.40, then we may go higher, but really I think we're probably going to chop around here for the time being, not doing an awful lot. As far as data goes this week, it shouldn't be forgotten that on Wednesday, I think it is, we've got the Q2 GDP numbers coming out. While the consensus is that Q2 GDP will grow by 0.5%, I have seen some people saying that we could contract by as much as 4.5%. Now that could put a real dent in the market. We'll have to wait and see on that. But given what's going on in Victoria and New South Wales in particular, I fail to see how we can see a positive number. So a dip later in the week would not really surprise me. Even so, I'd still be looking to buy dips down towards this 7,400 level. The vaccination numbers are good in Australia. They're growing quite significantly, and I think we probably need to look forward to when we actually come out of lockdown and the possibilities for a pretty sharp economic rebound heading into the end of the year. Well, that's the general idea, hopefully, anyway. Moving along then to gold, and here we have a 4-hour chart of gold. We had quite a nice spike higher to finish the week at 18.17, but we still really need to take out this sort of 18.30 level in order to inspire confidence of a further move higher, where resistance would come in at around this level here, so 18.65 being a long-term trend resistance. On the downside, I guess 1795 to 1800 will be initial support once again, and then back down here, this sort of 1780 level. Don't think we're really going there at this stage of the week. The 4-hour charts are pointing for higher, and the dailies equally having recovered from this sharp sell-off a couple of weeks ago. They look mildly positive, so I actually prefer to buy dips. If we blow this up a bit, we're really sitting on the 100 and 200 day moving averages here, and they look as though they're crossing, so we're probably actually cleared them or thereabouts on Friday. So I like to be long and look for a move towards 1860. Silver, that looks possibly even better than gold at the moment. Okay, here we have a 4-hour chart of silver, and that looks quite positive to me. If we blow this up a little bit, we've got these highs here all tying in with each other, but we've managed to close above them on Friday. With the 4-hour indicators looking okay, I think we can possibly head on up towards 24.70 or so, possibly even to beyond 25. I think that's going to be some way off at this point in time, but I think that's the direction of it. Stop losses, if you were to buy it here, I guess you keep a stop loss below this 23.30 level. I'd probably wait for a bit of a pullback to sort of 23.80 before buying it, but I think eventually it does go higher. And overall, I think I prefer this at the moment to gold. As far as the daily charts go, we haven't really got much resistance ahead of us. The 100 and 200 day moving averages don't come in until sort of 25.80 or so much further away than gold. We'll just go back and have a look at the daily gold chart. And here we have the price sitting right on the 100 and 200 day moving averages. So going back to silver, we've got quite a bit of catch up to do here. So I prefer to be long silver than gold at the moment, and looking for a run back towards these sort of levels here. Where's that? 26 basically. Oil, and here we have a 1 hour chart of West Texas, and this time last week we were looking at oil starting down around here, around 62.25, and it's finished the week at just under 69 bucks a barrel. So that was a pretty impressive rise. And just looking at the hourly chart here, I wonder if we might be building a bit of a pennant here for a test on 70 and beyond. We'll go and have a look at the 4 hours. So if we are to head higher, this trend resistance here, that comes in at sort of 71.5. We're going to find sellers at this sort of level between 69.5 and $70 a barrel, I guess. But if we can take that out, and I think we are heading in that direction, we might go back up here towards 71. On the downside, if you're going to be buying it, I'd keep a tight stop at 67.50, a deeper one perhaps if you can afford it below 67. But as far as the daily charts are concerned, they seem to have some positive momentum behind them. We are sitting right on this 100-day moving average. Having fallen 200-day moving average, that provided good support along with this low here. So we've seen a good bounce. Now back to the 100-day with the momentum indicators pointing higher. I do think we're probably likely to see a test of 71. And if we can break this, then maybe we go further on towards this previous high here at 74, although I'd be very doubtful of seeing that early in the week. So that's probably enough on the charts. We'll have a quick look at the calendar. Okay, here we are with the calendar for Monday, starting off with the UK summer bank holidays. London will be out, so liquidity will be somewhat thin. Then we move forward. We've got the German CPI data, and later in the day, secondary US data. We've got the penny home sales and the Dallas Fed Manufacturing Business Index. So that'll give us a clue as to how things are trending over there. Then on Tuesday, early Asia, we begin with some secondary Aussie and New Zealand data, and also the Chinese manufacturing and non-manufacturing PMIs. The Australian data will include the inflation numbers from Tordom and building permits and private sector credit. Moving right ahead, German unemployment. Then it all goes a bit thin, but we do have the EU preliminary August inflation numbers. And once again, some more secondary US data, the Case-Shiller home price numbers, the Chicago PMI, the house price index, also the consumer confidence, as well as the API numbers. So that'll be busy. Wednesday, we get to see the main event of the day, really. I think it's probably going to be the Australian Q2 GDP. As I said, the consensus is for about plus 0.5%, but I have seen some people suggesting it might be as much as 4.5% down on the quarter. So that, if that's the case, that will have ramifications for both the currency and the stock market, I suspect. Later on, we've got the German retail sales and the ADP numbers coming out of the States. Then on Thursday, also late on Wednesday, we've got the ISM numbers, so they'll be keenly watched. Thursday, some more secondary Australian and Kiwi data, terms of trade numbers from New Zealand, and the Australian trade balance. Then moving forward, we've got the jobless claims on Thursday. And then really waiting for the main event of the week. We have got the services and composite PMIs on Friday. But really, then we've got the European EU retail sales, but the main event will be the non-farm payrolls. It looks like 665,000 jobs being created is the current projection, and the unemployment rate is expected to drop to 5.2 to 5.4% according to the calendar. We'll have to wait and see. So it's going to be a pretty busy week, I think. Although, having said that, a lot of the market seems to be waiting from one event to the next, so it may be that we chop around going nowhere fast until the non-farm payrolls on Friday. But in the meantime, let's hope for a little bit of volatility, and good luck with your trading. Cheers.